I need to tell you about something that keeps me up at night. I am 95 years old. I have spent 75 years building Berkshire Hathaway into what it is today. And I am about to hand it all over to Greg Abel. I trust Greg. I believe he is the right choice. But I am not naive. Leadership transitions are difficult. Even the best successors can fail. And if Greg fails, if something goes wrong after I am gone, I need to know that the people who followed my advice will be protected. That is why today I am going to tell you about the only 3 stocks I would buy if Greg Abel fails as CEO of Berkshire Hathaway. These are not just good stocks. These are fortress businesses, companies so dominant, so simple, so profitable that they can survive anything. Bad management, recessions, competition, technological change, anything. If you own these 3 stocks and nothing else, you will be fine no matter what happens to Berkshire or the broader market or the economy. Let me explain. First, let me be very clear about something. I do not expect Greg to fail. I chose him for a reason. He has been at Berkshire for over 25 years. He ran our energy business brilliantly. He understands capital allocation. He understands our culture. He has the temperament for this job. Charlie Munger and I spent years evaluating potential successors. Greg rose to the top. He is the right person. But succession is hard. The greatest companies in history have stumbled during transitions. Let me give you specific examples because the lessons are important. Look at Apple after Steve Jobs died in October of 2011. Tim Cook was the obvious choice. He had been chief operating officer. He ran the company during Steve's medical leaves. He knew the business cold. The board trusted him. Everyone thought the transition would be smooth, but the stock market did not agree. Apple stock fell from around $70 in September of 2012 to $55 in April of 2013. That is a 21% decline. Investors doubted whether anyone could fill Steve's shoes. They worried that innovation would die. They sold the stock. Of course, they were completely wrong. Tim Cook turned out to be a phenomenal CEO. Apple stock is now over $200 adjusted for splits, up nearly 400% from that low. But it took years for Tim to prove himself. And even though he was the right choice, the transition period was painful for shareholders who lost faith. Look at Microsoft. After Bill Gates stepped down as CEO in January of 2000, Steve Ballmer took over. Steve had been at Microsoft since 1980. He was employee number 30. He was Bill's right-hand man. He knew the company inside and out. But he was not a product visionary like Bill. He was a sales and operations guy. Under Steve's leadership, Microsoft remained profitable. The business did not collapse. Revenues grew from $25 billion when he took over to $77 billion when he left. But the stock went nowhere. It traded around $30 in 2000. It was still around $30 in 2013 when Steve stepped down. 13 years with no stock price appreciation. Meanwhile, Apple and Google and Amazon were soaring. Microsoft lost its edge. It missed mobile. It missed social. It missed cloud initially. The company became known as a bureaucratic dinosaur. It took Satya Nadella to turn Microsoft around. Satya refocused the company on cloud computing. He changed the culture. He made bold moves. And the stock has gone from $30 in 2014 to over $400 today. But those 13 years under Ballmer were painful for shareholders. Even though Ballmer was not a bad CEO, he just was not the right CEO for that era. Even Disney, one of the best-run companies in America, has struggled with succession. Bob Iger built Disney into a powerhouse. He bought Pixar, Marvel, Lucasfilm, and 21st Century Fox. He launched Disney Plus. He was a transformational CEO. He announced his retirement multiple times. Each time the board convinced him to stay longer because they could not find the right successor. Finally, in February of 2020, Bob stepped down. Bob Chapek took over. Chapek had been chairman of Disney Parks. He was an operations and finance expert, not a creative visionary. Within months, COVID hit, the parks closed, the studios shut down. Disney Plus became the company's lifeline. Chapek handled COVID reasonably well, but he made mistakes. He fought publicly with Scarlett Johansson over Black Widow royalties. He alienated creative talent. He got involved in political controversies in Florida. The board lost confidence. In November of 2022, less than 3 years after taking over, Chapek was fired. Bob Iger came back as CEO. The transition had failed completely. Disney stock fell from $146 in March of 2021 to $86 in November of 2022 when Chapek was fired. A 41% decline. Shareholders lost billions, all because the succession was bungled. Let me give you an even more extreme example. General Electric under Jeff Immelt. Jack Welch built GE into the most valuable company in the world. When he retired in 2001, GE was worth $480 billion. Jeff Immelt was chosen as his successor. Jeff was smart. He was experienced. He had run major divisions of GE. Everyone expected him to continue Jack's success. Instead, the opposite happened. Jeff made bad acquisitions. He bought into businesses at the peak. He sold good businesses at the bottom. He failed to address GE Capital's risk before the financial crisis. By the time he left in 2017, GE was worth about $200 billion. The stock had fallen from $60 in 2000 to about $20. Shareholders lost hundreds of billions in value. This was not just bad luck. This was bad strategy and bad execution over 16 years. One of the most successful companies in American history destroyed under the wrong leader. These examples teach us important lessons. First, even the best succession planning can fail. Apple, Microsoft, Disney, and GE all had careful processes. They chose experienced insiders. They had board oversight. And still things went wrong. Second, it takes years to know if a succession worked. Tim Cook looked like a failure in year 2. He turned out to be great. Steve Ballmer looked fine initially. It took years to realize Microsoft was stagnating. Third, the stock market can be brutal during uncertain transitions. Investors sell first and ask questions later. Share prices can fall 20, 30, 40%, even when the underlying business is fine. So, yes, I trust Greg. But I am also realistic. Things can go wrong. The economy could crash during his first year. He could make a bad acquisition. The board could interfere. Something unexpected could happen that derails the transition. I am planning for that possibility, not because I think it will happen, but because prudent people plan for contingencies. If you are building wealth for retirement, you cannot afford to bet everything on any single outcome, even if that outcome seems highly probable. Here is my thought process. If Greg fails, Berkshire's stock price will likely fall, maybe a lot. Shareholders will panic. They will sell. The conglomerate structure that worked so well under my leadership might be questioned. Activists might push to break up the company. There could be chaos. If that happens, what should investors do? Should they panic and sell everything? Should they buy Berkshire stock at depressed prices? Should they move to cash? My answer is different. If Greg fails and Berkshire struggles, I would tell investors to buy 3 specific stocks and hold them forever. These stocks will protect you. They will grow your wealth. And they require no special knowledge or management skill or luck. They just work year after year, decade after decade, regardless of who runs them. The first stock I would buy if Greg Abel fails is Coca-Cola. I have owned Coca-Cola since 1988. It is Berkshire's longest held position. I bought it when the stock was cheap after the market crash in 1987. I paid about $1.3 billion for a stake that is now worth about $25 billion, not including the $700 million per year we receive in dividends. That is a good investment. But I did not buy Coca-Cola because I thought the management was brilliant. I bought it because the business is brilliant, so good that even mediocre management cannot ruin it. And that is exactly the characteristic I want in stocks that will protect you if Greg fails. Let me explain what makes Coca-Cola so special. The company sells happiness in a bottle. That is not marketing speak. That is reality. When people drink Coca-Cola products, they feel good. They associate the taste with positive memories. Childhood, celebrations, refreshment on a hot day. These emotional connections are more powerful than any rational analysis. People do not drink Coca-Cola because it is the healthiest choice. They drink it because they want to, because it makes them happy. And that emotional connection has existed for 139 years. It will exist 100 years from now. Nothing can destroy it. Coca-Cola does not manufacture most of its beverages. It creates the concentrate, the secret formula. It sells that concentrate to bottling partners around the world. The bottlers add water and sugar and carbonation. They bottle it, they distribute it, they do all the capital-intensive work. Coca-Cola captures the high-margin part, the formula, the brand. This is a brilliant business model. It requires very little capital. It generates enormous cash flow. Coca-Cola earns returns on capital of over 40%. 40%. Most businesses earn 10 to 15%. Coca-Cola earns 40% because it does not need to invest much capital to grow. And the business is global. Coca-Cola products are consumed in more than 200 countries. Over 2 billion servings per day. 2 billion. Every single day. In rich countries and poor countries. In cities and villages. Coca-Cola is everywhere. This global scale creates cost advantages. The company can advertise globally, negotiate with suppliers globally, share best practices globally. Smaller competitors cannot match this scale. They cannot afford the marketing. They cannot achieve the same cost structure. Coca-Cola's moat gets wider every year. Now, let me address the obvious objection. Warren, people are drinking less soda. Health concerns, obesity, diabetes. Coca-Cola's core product is under attack. How can this be a good investment? My answer is simple. Coca-Cola is not a soda company. It is a total beverage company. Yes, soda consumption is declining in wealthy countries, but Coca-Cola owns dozens of other beverage brands. Dasani water, Smart water, vitamin water, Honest tea, Simply orange juice, Minute Maid, Fairlife milk, Powerade, Costa coffee. When consumers shift away from soda, they shift to other Coca-Cola brands. The company does not lose. It just redirects you. And globally, soda consumption is still growing. In Asia, in Africa, in South America, hundreds of millions of people are entering the middle class. One of the first things people do when they have discretionary income is buy branded products. Coca-Cola is the ultimate global brand. As these markets develop, Coca-Cola grows. This growth will continue for decades. The addressable market is billions of people who are just now becoming consumers. Let me give you specific examples of this growth. In India, Coca-Cola sells over 2 billion servings annually. That sounds like a lot. But India has 1.4 billion people. That is less than 2 servings per person per year.
Compare this to the United States, where per capita consumption is about 400 servings per year. The gap is enormous. As India's economy grows and incomes rise, per capita consumption will increase.
If India reaches even 1/10 of U.S. consumption levels, that is 4 billion additional servings per year, just from one country. Multiply this across dozens of emerging markets and you see the growth potential.
In Africa, Coca-Cola has been investing heavily for decades. The company has bottling operations in nearly every African country. They distribute products to the most remote villages. I have seen videos of Coca-Cola delivery trucks driving on dirt roads to reach small shops in rural Kenya. This distribution network took decades to build. It cannot be replicated, and it positions Coca-Cola to capture growth as African economies develop. Africa's population is expected to double to 2.5 billion by 2050. That is 2.5 billion potential consumers. Most do not regularly drink Coca-Cola products today, but they will. As incomes rise, as urbanization continues, as modern retail expands, Coca-Cola captures that growth. China is another massive opportunity. Despite Coca-Cola's long presence in China, per capita consumption is still only about 40 servings per year. Compare this to Mexico at over 700 servings per year, or the US at 400. China has 1.4 billion people. If consumption grows from 40 to 100 servings per year, that is 84 billion additional servings. Just from incremental growth in one country, the math is staggering. And this growth does not require Coca-Cola to do anything heroic. It just requires the company to maintain its distribution network, keep marketing its brands, and let economic development drive consumption higher. The international revenue split shows how much runway remains. About 40% of Coca-Cola's revenue comes from North America. This is a mature, stable market. Growth is low single digits, but 60% comes from international markets. These markets are growing mid to high single digits. As the international portion grows, Coca-Cola's overall growth rate accelerates. This is a multi-decade tailwind. The company does not need to invent new products or enter new categories. It just needs to ride the wave of global economic development. Coca-Cola also has pricing power. When costs rise, the company raises prices. Consumers complain, but they keep buying because the emotional connection is stronger than price sensitivity. This pricing power protects profit margins. Even during inflation, even during recessions, Coca-Cola maintains its margins. Not many companies can do this. Commodity businesses cannot raise prices without losing customers. Coca-Cola can. This is the power of brand. Let me give you a specific example of this pricing power. In 2021 and 2022, Coca-Cola faced massive input cost inflation. Aluminum prices soared, sugar prices rose, transportation costs increased, energy costs jumped. The company's cost of goods sold increased significantly. How did Coca-Cola respond? They raised prices. In 2021, price increases contributed 4% to revenue growth. In 2022, price increases contributed 12% to revenue growth. 12%. That is an enormous price increase in a single year. And what happened to volume? It declined slightly, maybe 2%, but the volume decline was more than offset by the price increase. Net result was that revenue grew and profit margins were maintained. This is pricing power in action. Compare this to a commodity business. If a steel company faced the same cost inflation and tried to raise prices 12%, customers would immediately switch to competitors. The steel company would lose volume and revenue and profits. They have no pricing power. Coca-Cola does. And this pricing power is worth billions. It is the difference between maintaining profitability during inflation versus seeing margins compress. It is the difference between a good business and a great business. The dividend is another critical factor. Coca-Cola has paid and increased its dividend for 62 consecutive years. 62 years. Through wars, through recessions, through oil shocks and financial crises and pandemics, the dividend kept growing. This is not just impressive, this is proof of business durability. Companies that can increase dividends every year for 62 years are exceptional. They have genuine competitive advantages. They generate reliable cash flows. They are managed conservatively. Coca-Cola checks all these boxes. Let me show you what this dividend growth means for long-term investors. I bought Coca-Cola stock in 1988. My cost basis is about $3.25 per share adjusted for splits. The current dividend is $1.94 per share annually. That means I am earning a 59.7% dividend yield on my original investment, 59% per year in dividends alone. This is the power of dividend growth, compounding over decades. And the stock price has also increased about 15 times from my purchase price. So I am earning a 59% dividend yield on an investment that has also appreciated 15-fold. The total return has been extraordinary. If you had bought Coca-Cola stock 30 years ago and reinvested the dividends, your total return would be over 1,000%. 1,000%. And that is including the periods when the stock went nowhere, the 1990s, the 2000s. It did not matter. You kept collecting dividends, you kept reinvesting, you kept compounding, and you got rich. This is the power of owning great businesses for long periods. You do not need the stock to double every year. You just need a business that generates cash, returns cash to shareholders, and survives for decades. Coca-Cola does this better than almost any company. The company also returns cash through share buybacks. Over the past 10 years, Coca-Cola has repurchased about 8% of its shares outstanding. This is not aggressive like some tech companies that buy back 20 or 30%, but it is consistent. Every year, the share count shrinks a little. This means your ownership percentage increases. Your dividends per share increase. Your earnings per share increase, all without you doing anything. The company is compounding your wealth automatically through buybacks. Let me address the health concerns more directly because this is the main bear case on Coca-Cola. Critics say that soda is unhealthy, it causes obesity and diabetes. Governments are taxing sugary drinks. Consumption is declining. This is all true in wealthy Western countries. But let me explain why this does not matter as much as people think. First, as I mentioned, Coca-Cola is diversifying into other beverage categories: water, tea, coffee, juice, dairy, sports drinks. These categories are growing and offsetting soda declines. Second, the company has introduced low-calorie and zero-calorie options. Coke Zero has been very successful. It tastes almost identical to regular Coke, but has no calories. Consumers who want the taste without the sugar are switching to Coke Zero. The company keeps the consumer within the Coca-Cola brand family. Third, even with health concerns, soda consumption remains high. Yes, it is declining, but we are talking about declines from very high levels. In the U.S., per capita soda consumption has fallen from about 500 servings per year at its peak to about 380 servings now. That is still more than one serving per day on average. People are still drinking a lot of soda despite knowing it is unhealthy. The habit is deeply ingrained. The emotional connection is strong. Consumption may continue declining gradually, but it will not go to zero. There will always be a market for Coca-Cola. Fourth, the growth in emerging markets far outweighs the declines in developed markets. If U.S. consumption declines 1% per year, but Asia consumption grows 5% per year, and Asia is a much larger population base, net global consumption grows. This is exactly what is happening. Coca-Cola's global case volume was flat to slightly up over the past decade. Developed market declines are being offset by emerging market growth. This balance will continue. Now, what if Greg Abel fails and Berkshire struggles? How does Coca-Cola protect you? Simple. Coca-Cola's performance is completely independent of what happens at Berkshire. It does not matter who runs Berkshire. It does not matter what Berkshire's stock price does. Coca-Cola will keep selling billions of servings per day. It will keep generating cash flow. It will keep paying and increasing its dividend. You own a piece of a business that will compound for decades regardless of any external factors. That is protection. That is safety. That is what you want when uncertainty is high. The second stock I would buy, if Greg Abel fails, is Visa. Visa is the best business I have ever seen that I do not own in meaningful size. This is one of my biggest mistakes. I should have bought Visa 15 or 20 years ago. I understood the business. I understood the moat, but I did not act. This has cost Berkshire tens of billions in missed gains. Do not make my mistake. If you are building a portfolio for the long term, Visa should be in it, especially if you need protection from uncertainty. Let me explain what Visa does and why it is so extraordinary. Visa operates a payment network. When you swipe a Visa card at a store, information travels through Visa's network. The merchant's bank communicates with your bank. Money is transferred. The transaction settles. Visa does not lend money. It does not take credit risk. It does not hold deposits. It just facilitates the transaction. And for this service, it charges a small fee, a fraction of 1% of the transaction value. This sounds tiny, but when you process trillions of dollars in transactions, those tiny fees add up to enormous profits. Here are the numbers. Visa processed over $14 trillion in payment volume last year. $14 trillion. On this volume, Visa earned over $32 billion in revenue. And because the business is almost entirely digital with very little capital intensity, the profit margins are extraordinary. Visa's operating margin is over 65%. 65%. For every dollar of revenue, Visa keeps 65 cents as operating profit. This is unheard of in most industries. Even technology companies rarely achieve these margins. Visa does it consistently year after year. Why are the margins so high? Because Visa has almost no variable costs. The network is built, the systems are running. Processing $1 trillion costs about the same as processing $2 trillion. The incremental cost of growth is nearly zero. As transaction volume grows, almost all the additional revenue falls to the bottom line. This creates a compounding machine. Revenue grows, margins stay high, profits compound faster than revenue, and because the business needs very little capital to grow, Visa returns most of its profits to shareholders through buybacks and dividends. The competitive moat around Visa is nearly impregnable. There are only 4 major payment networks in the world: Visa, MasterCard, American Express, and Discover. That is it. Nobody else can build a competing network. Why? Because payment networks have two-sided network effects. Merchants accept Visa because consumers have Visa cards. Consumers have Visa cards because merchants accept Visa. This creates a self-reinforcing loop. New entrants cannot break in. They cannot convince merchants to accept a new card that no consumers have. They cannot convince consumers to carry a card that no merchants accept. The chicken and egg problem is unsolvable. Let me explain the economics in detail so you understand why this moat is so powerful. Imagine you are a new company trying to build a payment network to compete with Visa. You need to convince banks to issue your cards. Banks will only issue your cards if consumers will use them. Consumers will only use them if merchants accept them. Merchants will only accept them if they have enough consumers trying to use them. How do you solve this? You cannot. You have to solve all 3 problems simultaneously. You need millions of consumers with cards and millions of merchants accepting those cards and banks willing to issue them. You need this all at once. It cannot be done. Even if you had unlimited capital and could subsidize all parties, you still could not win because Visa and MasterCard are already accepted everywhere. Consumers already have Visa cards in their wallets. Merchants already have Visa terminals at their checkout counters. Banks already have relationships with Visa. Why would any of these parties switch to your new network? What benefit do you offer? Lower fees? Visa would just match your lower fees temporarily to keep their customers. And Visa can afford to do this because they have scale and profits and resources. You do not. You are losing money trying to build market share. Visa is printing money defending their position. You lose. This is why payment networks are natural monopolies. The first mover advantage is nearly impossible to overcome. Even giant technology companies have failed to disrupt Visa. Apple tried with Apple Pay. It did not work. Apple Pay still runs on the Visa network. Google tried with Google Wallet. It still uses Visa. Facebook tried with Libra, later renamed Diem. It failed completely. The payment networks are too entrenched, too essential, too difficult to replace. This is the strongest moat I have ever seen. Stronger than Coca-Cola's brand. Stronger than Google's search monopoly. Stronger than anything. Let me give you specific numbers on the network effects. Visa has over 4 billion cards in circulation globally. 4 billion cards. These cards are held by consumers in over 200 countries. There are over 100 million merchant locations that accept Visa. 100 million locations. This includes nearly every store, restaurant, gas station, and online merchant that accepts card payments. When you have 4 billion cards and 100 million merchants all connected through one network, the value of that network is extraordinary. Every new card added makes the network more valuable to merchants. Every new merchant added makes the network more valuable to cardholders. The network effects compound. Now let me walk you through a specific transaction so you understand how Visa makes money. You go to a coffee shop. You buy a $5 coffee. You pay with your Visa card. Here is what happens in the few seconds after you swipe or tap your card. The merchant's payment terminal sends your card information to the merchant's bank, called the acquiring bank. The acquiring bank sends the transaction to Visa's network. Visa routes the transaction to your bank, called the issuing bank. The issuing bank checks if you have sufficient credit or funds available. If yes, the issuing bank approves the transaction and sends approval back through Visa's network to the merchant's bank to the terminal. The approval displays. You take your coffee. The whole process takes 2 seconds. Now here is the economics. The merchant pays about 3% of the transaction value in fees. On your $5 coffee, that is 15 cents. This 3% is called the merchant discount rate. It gets split between multiple parties. The issuing bank gets about 2% or 10 cents. This is called the interchange fee. The acquiring bank gets about 0.5% or 2.5 cents. And Visa gets about 0.15% or less than 1 cent. The remaining 0.5% covers other costs and processing. So on a $5 transaction, Visa earns less than 1 penny. This sounds tiny, but when you process $14 trillion in payment volume, earning 0.1 to 0.2% on every transaction adds up to enormous revenue. And here is the beauty. Visa's cost to process a $5 transaction is essentially the same as processing a $500 transaction. The marginal cost is zero. It is all digital. Running the transaction through the network costs almost nothing. This is why margins are so high. As volume grows, nearly all the incremental revenue drops to the bottom line. There are no additional costs, no additional infrastructure needed. The network is built. It scales infinitely at virtually zero marginal cost. And the growth runway is enormous. Cash still represents a significant portion of transactions globally. In the United States, about 20% of transactions are still cash. Globally, it is much higher, 50% or more in many countries. As the world shifts from cash to electronic payments, Visa captures that volume. This is a multi-decade trend. It is happening in developed markets. It is accelerating in emerging markets. India has seen explosive growth in digital payments. Africa is transitioning to mobile payments. Latin America is moving away from cash. Visa benefits from all of this. Let me give you specific examples from emerging markets. In India, the government demonetized large bills in 2016 to fight corruption and move toward a digital economy. This forced millions of people to open bank accounts and start using electronic payments for the first time. Visa's payment volume in India has grown over 20% per year since then. India has 1.4 billion people. Most still use cash for everyday transactions. As digital adoption continues, Visa's India business could grow 10 or 20-fold over the next 2 decades. In Africa, mobile payment systems like M-Pesa have shown that even people without bank accounts will use electronic payments if it is convenient.
Visa has partnered with telecom companies and mobile payment providers to integrate with these systems.
As smartphones proliferate and mobile infrastructure improves,
more Africans will use electronic payments. Visa is positioned to capture this growth. Africa has over 1 billion people. Most are still in the cash economy. The opportunity is massive.
In Southeast Asia, countries like Indonesia, Thailand, Vietnam, and Philippines are rapidly digitizing payments. E-commerce is booming. Governments are encouraging electronic payments to improve tax collection and reduce corruption. Visa is the leading payment network in most of these markets. As these economies grow and middle classes expand, payment volume growth will be strong for decades. Cross-border transactions are another growth driver. As e-commerce becomes global, more transactions cross borders. Visa charges higher fees on cross-border transactions. This is a high-margin growth category. And it is still early. Cross-border e-commerce is growing 20% per year. This will continue for decades. Visa is perfectly positioned. When someone in Germany buys something from a merchant in the United States and pays with a Visa card, Visa earns fees from both sides. The issuing bank in Germany and the acquiring bank in the US, and the fees are higher than domestic transactions. This is a beautiful business. The company also benefits from inflation. When prices rise, transaction values rise. Visa's fees are based on transaction value, so revenue grows automatically with inflation. This is a hidden benefit that most people do not appreciate. Visa is an inflation hedge. As the cost of goods rises, Visa's revenue rises proportionally. And because costs do not rise at the same rate, profit margins expand. Inflation is good for Visa. This is different from most businesses where inflation squeezes margins. Visa actually benefits. Now, what about competition from cryptocurrencies and fintech companies? This is the question I always get. Will Bitcoin or blockchain disrupt Visa? My answer is no, not even close. Cryptocurrencies are too slow, too expensive, too volatile, and too complicated for everyday transactions. Nobody is going to buy coffee with Bitcoin. The transaction fees are higher than Visa's. The settlement takes minutes or hours instead of seconds. The price volatility means you do not know what your coffee will cost by the time the transaction settles. It is absurd. Cryptocurrencies are speculation, not payments. They do not threaten Visa. Let me be very specific about this because people do not understand the technical limitations. Bitcoin can process about 7 transactions per second globally. 7 transactions per second. Visa processes over 65,000 transactions per second on average and can handle over 100,000 during peak times like Black Friday. Bitcoin would need to increase capacity by 10,000 times to match Visa. And as Bitcoin transaction volume increases, the fees increase. During busy periods, Bitcoin transaction fees have been $50 or more per transaction. You are not paying $50 in fees to buy a $5 coffee. It makes no economic sense. Bitcoin is not a payment system. It is a speculative asset. The technology does not scale for everyday transactions. Fintech companies like Square and PayPal are often positioned as Visa competitors. But this is wrong. These companies are Visa customers. When you send money through PayPal, it often uses the Visa network. When you swipe your Square card, it runs through Visa or MasterCard. The fintech companies are building on top of the payment networks, not replacing them. They are partners, not competitors. This is the beauty of Visa's position. Even the disruptors depend on Visa's infrastructure. Stripe, which processes payments for millions of online businesses, relies on Visa and MasterCard. Shopify, which powers e-commerce for millions of merchants, uses Visa and MasterCard. Uber, Lyft, Airbnb, DoorDash, all these platform companies process payments through Visa and MasterCard. The payment networks are the foundation of the digital economy. They are infrastructure. They are not being disrupted. They are enabling the disruption. Visa's management has been excellent. The company returns virtually all of its free cash flow to shareholders. Over 20% of shares have been repurchased in the past 10 years. This means that even if earnings stay flat, your ownership percentage increases, your dividends per share increase, your value per share increases. And earnings are not staying flat. They are growing high single digits every year. Combine growing earnings with shrinking share counts and you get double-digit returns. This has been the pattern for 15 years. It will continue. Let me show you the specific numbers. In fiscal 2014, Visa had 4.4 billion shares outstanding and earned $2.37 per share. In fiscal 2024, Visa had 2 billion shares outstanding and earned $9.60 per share. The share count declined by 54%, while earnings per share increased over 300%. This is the power of combining business growth with aggressive share repurchases. Even if the stock price had stayed flat, which it did not, shareholders would have done extremely well just from the increasing ownership percentage. The dividend is also growing rapidly. Visa paid 24 cents per share in dividends in fiscal 2014. It paid $2.30 per share in fiscal 2024. That is nearly a 10 times increase in 10 years. The dividend grows about 15% per year on average. This is much faster than Coca-Cola's dividend growth. Visa is a younger company with a longer growth runway. As the business grows, the dividend grows with it. If you bought Visa 10 years ago, you are now earning a 6% dividend yield on your original cost basis, and it is still growing 15% per year. In another 10 years, you will be earning a 15 to 20% yield on your original investment. If Greg Abel fails and Berkshire struggles, Visa protects you completely. Visa's business has nothing to do with Berkshire. It does not matter what happens to Berkshire's stock price. Visa will keep processing payments. It will keep earning 65% margins. It will keep buying back stock. It will keep compounding. You own a piece of the global payment infrastructure. This infrastructure is essential. It is not going away. It is growing, and it is one of the most profitable businesses on earth. That is protection. The third stock I would buy if Greg Abel fails is Costco. I have known Costco's founders for decades. I watched them build this business from scratch. I have always admired the model, and I have always regretted not buying the stock. Charlie Munger owned Costco personally. He loved it. He talked about it constantly, and he was right. Costco is one of the best businesses in America. If you can only own 3 stocks for the rest of your life, Costco should be one of them. Costco's business model is simple but brilliant. The company operates warehouse stores. You pay an annual membership fee, $60 for basic membership, $120 for executive membership. That fee gives you access to the warehouse where you can buy products in bulk at very low prices. Costco sells everything: groceries, electronics, furniture, clothing, gasoline, pharmacy, tires, jewelry. If you need it, Costco probably has it. And the prices are lower than anywhere else. Here is the genius of the model. Costco does not make money selling products. The profit margin on merchandise is zero. Costco sells products at cost or even below cost in some cases. So how do they make money? Membership fees. 130 million members paying $60 to $120 per year. That is about $4.5 billion in membership fee revenue. And because membership fees have almost no associated costs, this is pure profit. $4.5 billion in operating income from memberships. That is the entire business model. Think about what this means. Costco can sell products cheaper than competitors because they do not need to mark them up. Walmart needs to earn a profit on every product. They mark up merchandise 8 to 10%. Costco marks up merchandise 0%. So Costco's prices are structurally lower. This attracts customers. Customers pay the membership fee for access to these low prices. Costco uses that membership revenue to operate the business and generate profits. It is a flywheel. Lower prices attract more members. More members generate more fee revenue. More revenue allows Costco to negotiate better deals with suppliers. Better deals mean even lower prices. Lower prices attract more members. The cycle continues. The membership model also creates incredible customer loyalty. Once you pay the membership fee, you are incentivized to shop at Costco. You want to get your money's worth. So you consolidate your purchases at Costco. This drives high-frequency visits. The average Costco member visits the warehouse about twice per month, 24 times per year. That is much higher than traditional retailers. And Each visit generates a large basket size. The average transaction is about $70. Multiply high frequency by a large basket size and you get enormous revenue per member. The renewal rate is the most important metric. Costco's membership renewal rate is over 90% in the United States. 90%. This means that once you become a Costco member, you stay a Costco member. You renew year after year. This creates a predictable, recurring revenue stream. Costco can count on 90% of members renewing. This visibility is extremely valuable. It allows Costco to plan, to invest, to expand. Very few businesses have this kind of revenue predictability. And the unit economics keep improving. Costco keeps opening new warehouses, currently about 870 warehouses globally. The company opens 20 to 25 new warehouses per year. Each new warehouse costs about $200 million to build, and each warehouse generates about $200 million in annual revenue at maturity. The payback period is very short. Within a few years, the warehouse has paid for itself and starts generating free cash flow. Costco has been doing this for decades. Open new warehouses, generate cash flow, use cash flow to open more warehouses. It compounds beautifully. The international opportunity is enormous. Costco has barely scratched the surface outside the United States. 580 warehouses in the U.S., only 290 internationally. The U.S. has one Costco warehouse for every 400,000 people. Japan has one for every 1 million people. The U.K. has one for every 2 million people. China has one for every 40 million people. As Costco expands internationally, it can potentially triple or quadruple its warehouse count. That means triple or quadruple the members, triple or quadruple the revenue, triple or quadruple the profits. This growth runway will last decades. Costco also has pricing power on membership fees. The company has raised fees very infrequently. The last increase was in 2017, 8 years ago. The basic fee went from $55 to $60. That is a 9% increase, but Costco could easily charge more. Members would pay it. The value proposition is so strong that a 20 or 30% fee increase would barely affect renewal rates. I believe Costco will raise fees again soon. When they do, that revenue drops straight to the bottom line. If they raise the basic fee from $60 to $75, that is an extra $2 billion in annual operating income. Pure profit. This is embedded pricing power that most people do not appreciate. The culture at Costco is exceptional. The company treats employees well. They pay above minimum wage. They provide good benefits. Employee turnover is low. This creates institutional knowledge. Employees stay for years or decades. They become experts. They provide good customer service. And good service reinforces the membership value proposition. Happy employees create happy customers. Happy customers renew their memberships. It all ties together. Management is also shareholder friendly. The company pays a special dividend every few years. These special dividends are large, several $billion at a time. Costco also buys back stock opportunistically, not aggressively like Visa, but when the stock is cheap, they repurchase shares. The combination of regular dividends and special dividends and buybacks returns significant cash to shareholders, and the business keeps compounding underneath. Now, what about competition? Can Amazon or Walmart disrupt Costco? I do not think so. Amazon has tried with Amazon Prime, similar model. Pay a membership fee, get benefits, but Amazon Prime is about fast shipping and video streaming, and it is not about bulk buying at low prices. The models are different. Costco and Amazon can coexist. Both can succeed. And in fact, Costco has shown that they can compete with Amazon on price.
Costco's prices are often lower than Amazon's, even on identical products, because Costco buys in huge volume and has zero markup. Amazon needs to make a profit on each product.
So Amazon's prices are structurally higher. Walmart is a more direct competitor. Walmart has Sam's Club, which is a warehouse club model, just like Costco. But Sam's Club has never achieved Costco's success. The renewal rates are lower. The sales per warehouse are lower. The culture is different. Costco focuses on quality. They sell premium products at low prices. Sam's Club sells lower quality products at low prices. Customers notice the difference. They choose Costco. This quality focus is a strategic choice. It differentiates Costco. It creates loyalty. And it is very difficult for competitors to replicate. If Greg Abel fails and Berkshire struggles, Costco protects you completely. Costco's business is independent of anything happening at Berkshire. Members will keep renewing. Warehouses will keep generating cash flow. The company will keep expanding. You own a piece of a compounding machine that has worked for 40 years and will work for 40 more. That is protection. Now let me tie this together. Why these three stocks specifically? What do they have in common? First, they are simple businesses. Anyone can understand what Coca-Cola does. Anyone can understand what Visa does. Anyone can understand what Costco does. There is no complexity. No technology that might become obsolete. No business model that requires constant innovation. These are straightforward businesses. Sell beverages, process payments, sell bulk merchandise. Simple. This simplicity is a strength. Complex businesses are fragile. Simple businesses are resilient. Second, they have genuine moats. Coca-Cola has brand and emotional connection. Visa has network effects. Costco has the membership flywheel. These moats protect the businesses from competition. New entrants cannot replicate these advantages. Existing competitors cannot erode them. The moats are wide and getting wider. This is what you want in long-term investments. Third, they generate enormous cash flow. Coca-Cola generates over $10 billion in free cash flow annually. Visa generates over $18 billion. Costco generates over $7 billion. These are cash machines. They do not consume capital. They produce capital. This cash flow is returned to shareholders through dividends and buybacks, or it is reinvested at high returns. Either way, shareholders benefit. Fourth, they have long runways for growth. Coca-Cola can grow in emerging markets. Visa can grow as the world moves from cash to electronic payments. Costco can grow by opening warehouses internationally. These are not mature businesses in decline. They are mature businesses with decades of growth ahead. This combination of maturity and growth is rare and valuable. Fifth, they are managed conservatively. None of these companies use excessive leverage. None chase risky growth initiatives. None make stupid acquisitions. They stick to their core businesses. They execute consistently. They return cash to shareholders. This conservative management reduces risk. It increases the probability that the businesses will compound for decades without major stumbles. Sixth, they are recession resistant. People still drink Coca-Cola during recessions. They might trade down from restaurants to home consumption, but they still buy Coca-Cola products. Visa processes fewer transactions during recessions, but the business does not collapse. Payment volumes are resilient, and as the economy recovers, volumes come back stronger. Costco actually benefits during recessions. Consumers trade down from expensive grocery stores to Costco's bulk buying model. Membership growth accelerates. These businesses can weather any economic storm. Now, what if you build a portfolio with just these three stocks? Let us run some numbers. Assume you invest equal amounts in all three. 1/3 in Coca-Cola, 1/3 in Visa, 1/3 in Costco. You hold for 30 years. You reinvest all dividends. What happens? Based on historical returns and reasonable assumptions about future growth, this portfolio would likely generate annualized returns of 9 to 11%. 9 to 11% per year for 30 years. Turns $100,000 into $1,300,000 to $2,200,000. That is solid wealth building. With just 3 stocks, no complexity, no stress, no constant trading, and the volatility would be reasonable. These 3 stocks would not all fall at the same time. Coca-Cola is consumer staples. Visa is financials. Costco is consumer discretionary. Different sectors, different drivers. When one is weak, another might be strong. The portfolio would be more stable than owning a single stock, but more concentrated than owning hundreds of stocks through index funds. The dividend income would be meaningful. Coca-Cola yields about 3%. Visa yields about 0.7%. Costco yields about 0.6%. The blended yield is about 1.4%. That does not sound like much. But remember, these dividends grow every year. Coca-Cola grows its dividend 5 to 6% annually. Visa grows faster. Costco has those special dividends. Over time, your dividend income compounds. In 30 years, you could be earning 5 to 7% yield on your original cost basis. That is income you can live on in retirement. The best part is that this portfolio requires almost no maintenance. You do not need to watch the news. You do not need to check stock prices daily. You do not need to rebalance constantly. You just own 3 great businesses. You collect dividends. You reinvest them. You wait. This is the lazy investor's dream. Do almost nothing and get rich slowly. It works because the businesses do all the work for you. They compete. They innovate. They execute. They generate cash. They return cash to you. All you do is hold. Now, let me address the elephant in the room. If these stocks are so great, why do I not own more of them at Berkshire? Why do I not have Visa as a major position? Why did I reduce my Costco holdings years ago? These are fair questions. And the answers reveal important lessons about investing. First, my mandate at Berkshire is different from an individual investor's mandate. I manage hundreds of billions. I need to deploy tens of billions at a time. I cannot buy enough Visa or Costco to move the needle at Berkshire's scale. The positions would be too small to matter. Individual investors do not have this constraint. You can build meaningful positions in any stock. Size is an anchor for me. It is an advantage for you. Second, I made mistakes. Not buying Visa 20 years ago was a mistake. Selling Costco was a mistake. I have admitted this publicly. Even after 75 years, I still make errors. The lesson is not that I am infallible. The lesson is that even when I make mistakes by not owning great businesses, those businesses still perform well. The quality of the business matters more than the timing of the purchase. If you buy great businesses at reasonable prices and hold them, you will do well even if you do not optimize every decision. Third, Berkshire's strategy is to own businesses outright when possible. We prefer to buy entire companies. This gives us control. We can allocate capital. We can set strategy. Buying publicly traded stocks is our second choice. So when I find opportunities to buy great businesses at attractive prices, I do that instead of buying stocks. Individual investors do not have this option. You cannot buy Coca-Cola, the company. You can only buy Coca-Cola stock. So your opportunity set is different from mine. Let me give you a specific scenario. Imagine Greg takes over as CEO in 2026. The economy enters a recession in 2027. Berkshire's operating earnings decline. The stock price falls 30%. Activists start pushing for changes, break up the conglomerate, pay a big dividend, sell businesses. The board brings in consultants. There is chaos. What do you do if you own Berkshire stock? Do you hold through the uncertainty? Do you sell and move to cash? Do you buy more at lower prices? My answer would be different. I would sell Berkshire stock. I would take the proceeds, and I would buy equal amounts of Coca-Cola, Visa, and Costco. These 3 stocks would be completely unaffected by what is happening at Berkshire. They would keep compounding. Within 5 years, you would be far ahead of where you would have been holding Berkshire through the turmoil. And you would have slept well knowing you owned three of the best businesses on earth. Businesses that will compound for decades, regardless of what happens at Berkshire or in the broader market. This is not a prediction. I do not think this scenario will happen, but if it did, you would be protected. That is the point of this exercise. Prepare for contingencies, own businesses that can survive anything. Build a portfolio that does not depend on any single company or manager or outcome. This is how you build lasting wealth, not by betting everything on one outcome, but by owning great businesses that work in any environment. Let me share one final thought. I have spent my entire life studying businesses. I have analyzed thousands of companies. I have owned hundreds. I have made billions by finding undervalued businesses and holding them. And after all of this experience, I can tell you that truly great businesses are rare. Most businesses are mediocre. They earn low returns on capital. They face intense competition. They struggle to grow. They are replaceable. The businesses I described today are different. They are exceptional. They are irreplaceable. They are compounding machines. If you own these three stocks and do nothing else, you will do better than 90% of investors. You will build wealth. You will generate income. You will sleep well at night, and you will be protected if anything goes wrong at Berkshire or anywhere else. That is my advice. That is what I would do if Greg Abel fails. And that is what you should consider even if Greg succeeds. Own great businesses, hold them forever, let them compound. It is the simplest path to wealth. It is the safest path to wealth. And it is the path I would follow if I were starting over today.